They say the system is fine, the banks are strong, the economy is resilient. But if everything is so stable, why are small banks quietly collapsing, credit freezing up, and billionaires moving their cash into gold and Bitcoin? The real banking crisis of 2025 isn't making headlines, but it's already here. Welcome to a story they hope you won't notice. A story buried beneath positive press releases, stock market rallies, and carefully worded Fed statements. This isn't about one big Lehman-style collapse. It's about a slow, quiet unraveling. A hidden crisis playing out in regional banks, in silent layoffs, in declining loan approvals, and in the rising desperation of everyday savers and small businesses. In this video, we'll break down what's really going on in the banking system in 2025. What triggered it, who's trying to cover it up, and what this means for your money. Because the truth is, most people won't realize there's a problem until it's too late. Background: how we got here. To understand the crisis in 2025, we have to rewind a bit. After the 2008 financial crash, governments flooded the global economy with easy money. Then came COVID, and with it, even more money printing. Interest rates hit zero, banks lent freely, and for years, risk didn't seem to matter. But in 2022 and 2023, inflation hit hard. The Federal Reserve and other central banks panicked. They began aggressively raising interest rates to tame inflation, pushing borrowing costs to their highest levels in decades. This had a delayed but deadly effect on banks. Many banks, especially smaller ones, had loaded up on long-term bonds during the zero-interest era. These bonds lost value as rates went up. At the same time, depositors began pulling their money to chase higher yields in money market accounts and treasury ETFs. Suddenly, banks were stuck. Their assets had dropped in value. Their liabilities, the deposits people wanted to withdraw, remained. It was a ticking time bomb. In 2023 and 2024, we saw early warning signs. Silicon Valley Bank, Signature Bank, First Republic, all collapsed. The media treated them like isolated events. Poor management, they said, one-off issues. But by 2025, it's clear. These weren't isolated, they were the beginning. The signs you're not seeing. Fast forward to now, 2025. We're not seeing massive bank runs on the evening news, but the crisis hasn't disappeared. It's just gone underground. Look closer. Dozens of regional banks are quietly merging or being acquired. Why? Because they're insolvent. But regulators are trying to avoid panic by orchestrating silent bailouts. Loan approvals have plummeted. A small business that could easily get a loan 2 years ago is now rejected. The reason? Banks are hoarding liquidity. They're terrified of running out of cash. More quietly, behind the scenes, banks are tightening credit lines, reevaluating commercial real estate portfolios, and pushing clients toward fee-generating products just to stay afloat. Another red flag? The FDIC insurance fund, the pot of money that protects your bank deposits, has been rapidly depleted. It was never designed to handle multiple collapses at once. In fact, the fund only covers a fraction of total US deposits. If a systemic wave of collapses hits, the FDIC can't save everyone. And trust me, they know it. Who's hurting the most? This isn't just a finance story, it's personal. Small businesses are being hit the hardest. Many relied on regional banks for lines of credit, equipment loans, or commercial mortgages. But those banks are now pulling back. If you can't get a loan, you can't grow. In some cases, you can't even survive. Homebuyers are also feeling the sting. Mortgage rates are still high, but it's not just the cost, it's the availability. Many banks are afraid to issue 30-year mortgages right now, especially with uncertainty in real estate markets. Then there's the average saver. Banks have started offering teaser rates to attract deposits, but in the background, they're quietly layering in fees, restrictions, and tighter withdrawal limits. Some accounts now charge fees just to hold your money. It's not just a squeeze, it's a quiet bleed. And yet, the big guys, they're fine. The top 4 megabanks, JP Morgan Chase, Bank of America, Citigroup, and Wells Fargo, are gaining market share. In every collapse, they get bigger. Which begs the question, is this a crisis or a controlled demolition? How they're hiding it. So why haven't you heard more about this? Simple. Distraction and spin. Politicians need to project strength. Admitting a banking crisis, even a small one, could spark panic. So they sugarcoat the numbers. Regulators quietly approve backroom deals. And the media? Focused on AI hype, celebrity gossip, and election drama. Meanwhile, the Fed and Treasury are quietly supporting struggling banks through emergency loan programs. But they don't call it a bailout. They rebrand it. Liquidity support, temporary lending facility, market stability operation. The words change, but the game stays the same. And let's not forget central bank digital currencies, CBDCs, quietly being tested, framed as convenience, but in reality, A tool that could give central authorities the power to freeze or redirect funds in real time if the banking system cracks too far. Imagine a world where they can force your money into a safer institution. Whether you like it or not, a system under stress. You may be wondering, is this as bad as 2008? In some ways, it's worse. 2008 was a shock to the system. Violent but brief. This is death by 1,000 cuts. A prolonged liquidity squeeze. A slow-motion consolidation of financial power. The system hasn't collapsed, yet, but it's become deeply fragile. One major shock, a geopolitical crisis, a large-scale cyber attack, a global recession, could trigger a cascade. Already, commercial real estate is teetering. Office spaces in major cities remain half-empty. Banks holding those mortgages are under extreme pressure. Student loan repayments, resumed in 2024, are adding new weight to consumer balance sheets. Delinquencies are rising. Credit card defaults are creeping up. It's not just about bad loans, it's about confidence. If enough people lose trust in the banks, if just a few more cracks appear, the illusion breaks, and once it breaks, it's very, very hard to fix. What you can do. So what does this mean for you? First, diversify your risk. Don't keep all your money in one bank, especially not a small one with a shaky balance sheet. Use tools to check a bank's financial health. FDIC insured? Good, but don't rely on that alone. Second, keep some liquidity outside the system. This doesn't mean burying cash in the backyard, but having physical assets, secure digital wallets, and even precious metals can give you peace of mind if there's a disruption. Third, watch your credit. Lines of credit are being closed with no warning. Refinance or restructure debt while you still can. Once the banks freeze up, you're locked out. And finally, stay informed. Don't wait for CNN to tell you what's happening. Follow alternative financial analysts. Read the footnotes of Fed reports. Pay attention to what insiders are doing, not just what they're saying. Because the truth is, the hidden banking crisis of 2025 isn't coming. It's already here. What do you think? Is this the calm before the storm, or are we already in the eye of it? Have you seen signs in your own community? A closed bank branch, a rejected loan, tighter fees? Let's talk about it in the comments. And if you found this video helpful, do me a favor. Hit that like button, subscribe for more deep dives like this, and share it with someone who needs to hear the truth behind the headlines. Because the financial system may be fragile, but your awareness doesn't have to be. Stay sharp, stay prepared, and don't let polished headlines fool you. Your financial future depends on what you do before the panic starts. Keep asking questions, keep watching the signs. The truth always leaves a trail. And remember, the biggest risks are often the ones hiding in plain sight. Thanks for watching, and I'll see you in the next one. Take care.